On the Spot with Michelle Makori is brought to you by Prime XBT.
Gold has hit a new all-time high, touching $2,085 per ounce. This as the banking crisis in the U.S. seems far from over, with more regional banks teetering on the edge following the collapse of First Republic, SVB, and Signature Bank. And as the Fed is sticking with its aggressive tightening, raising rates by another 25 basis points to more than 5%, but hinting that there could be a potential pause in June. There are also warnings from Treasury Secretary Yellen that the U.S. will hit its debt ceiling in June and that a default would be an economic catastrophe. Meanwhile, on the macro front, the de-dollarization trend is gaining momentum. So what is next for gold, and where are the opportunities for investors? Let's discuss with renowned speculator and resource investor Lobo Tiggre. Lobo is the editor of the Independent Speculator. He has decades of experience in the mining sector, including as a senior investment strategist at KC Research. Welcome back, Lobo.
I'm impressed you remembered all that. Happy to be back with Kitco.
Always good to have you. And Lobo, last time we spoke was in January, and you told me that you could say with conviction that gold will reach an all-time high in 2023. You were right. COMEX gold prices reached that all-time high, with gold hitting $2,085 and I believe 40 cents per ounce. But with gold, Lobo, you tend to get different readings on what the price is based on spot, based on futures contracts. So explain that and explain this all-time high.
Well, two separate questions. I think it is an important point to pause because you'll have some arguments. Oh, no, that's not what it was this. And Peter Schiff will say one thing and Adrian Day will say another and so on. And it's not that somebody's wrong. It's just that there are different prices quoted. You know, if you go down to your local coin shop and the dealer gives you X, there's no way the whole world can know that. So we look at readily quoted, electronically available sources of pricing. And COMEX futures is one, London fixes is another. Kitco has one that I think is a little more conservative that we see there. If you look at the contracts quoted on, say, marketwatch.com or Yahoo Finance, they're often a little bit higher. And this tends to annoy gold bugs. Why is Kitco not reporting the higher gold price? It's just a different contract. It's nothing to get upset about. It's nothing nefarious. You know, some people use front contracts. Some people use most frequently traded. Some just stick with London fixes. They're just different numbers, but they're all tracking the same underlying reality. And I don't think we need to quibble about whether or not gold hit a new all-time high. It did. And that's a meaningful signal.
All right. Are you ready then to call a bottom for gold for 2023?
You bring out the worst in me, Michelle. I'm not Mr. Bold Predictions clickbait headlines, but you got me on stage there in Vancouver. You put me on the spot. So I made that.
The show is called On the Spot, Lobo. That's the name of the show.
Is it really? Well, okay. Walked right into that one. But no, I won't back up. And, a lot of people said that gold was going up this year. I'm not the only person who called for gold to rise this year. I think the difference is that I'm not the guy who every year says it's making a new all-time high. I try to be a little bit more measured. And I felt quite confident looking at the situation that we'll get into, the macro and all, that this is where we're going. So where do we go next? And I will tell you, here's your exclusive Kitco viewers. I don't think this is the top. I don't think that was it. We hit the new all-time high and now we take our profits and move along. I think this is the beginning. The very factors that prompted me to make that call in January tell me that we're still going higher now. And this includes both the monetary situation, what's happening with the dollar, the euro, and their evil gang of fiat currencies, and also the safe haven aspect, what's going on with the economy, the US and the global economy. Where you want to take it from there is up to you, Michelle, but the call here is we're still going higher, not without fluctuations along the way, but I anticipate higher prices before the end of this year.
So back to my question then, Lobo, can you give me a bottom or a support line that you think you're comfortable with?
Well, I'm not a TA, but I will say that I think that there's room for a retreat. As you and I are recording, we've backed off significantly from that level, but it's not a hair pulling sort of retreat. We're retreating to well above 2000. I mean, here's something for the audience to think about. Gold averaged north of $2,000 per ounce for the entire month of April. Right? So never mind the peak. To have an entire month at that level, well, in the first place, the miners make money. You know, the better ones are printing money at that kind of price, and that's significant. So if you are technically minded, you could look at something around the 2000 level as a floor or something like that. I tend to be more of a fundamentalist. I think the issue right now is that the Eurozone is sort of catching up with the Fed. The Fed led the way in tightening. It's led the way in easing up. And now the ECB is starting to ease up. They went from 50 to 25 as well. So, you know, that might lend some strength to the dollar, which would be a headwind for gold. But this is all window dressing. It's around the side. It doesn't change, you know, all that money printing that still has to go through the Python. It doesn't change the safe haven scenario. Mm-hmm. And in fact, you know, the recession seems to me to be headed for the US faster and more viciously than Europe, which will impact the dollar first again.
Okay, well, you touched on recession, and that's exactly what I want to get your thoughts on. And that's the macro economy before we circle back to gold. And let's start off with these job numbers that we just received, because job growth fared better than expected in April, despite this turmoil in the banking sector, despite the economy slowing down. Non-farm payrolls increased by 253,000 for April, beating Wall Street estimates for 180,000. The unemployment rate was 3.4%, beating an estimate of 3.6%, and that 3.4% is tied for the lowest level of unemployment since 1969. Labor participation rate staying more or less the same. And then we had Fed Chair Jerome Powell saying earlier this week that he does think a soft landing is still possible. He's still hopeful that there could be a mild recession. And his words exactly were, the case of avoiding a recession is, in my view, more likely than that of having a recession. But it's not that the case of having a recession is, don't rule that out either. It's possible we will have what I hope would be a mild recession. So you've got this unemployment data.
At the same time, he also said that he thought the banking panic or crisis, or we don't want to call it a crisis, the banking situation, you know, that was all okay now.
That the banking sector was sound and resilient.
Hours, yes, within 15 hours, we had another bank blow up, right? So, you know, don't listen to this guy. That's not just me being hyperbolic.
Okay, so let's listen to Lobo. And you're right. Powell has had a record of saying one thing and another thing transpiring. What is your outlook? Are you still thinking we're going to see a stagflation?
Yes. But I got to say, you know, the Fed cannot tell the truth. Powell cannot tell you, even if he knows there's a recession coming, because that would cause it. So you just can't listen to that. That's just not a source. Yes, I do think we're still headed for recession and stagflation. Some people think of these as different things. I think you can have an inflationary recession, which in conventional economics isn't even possible. A recession means deflation, almost by definition. I think that's incorrect. I think if you have enough money printing while the economy is weakening, you can have both. And I think that's where we're headed. I also think that even if there is, you know, a flash of negative CPI 1 month or two, as we've seen before in 2020 and 2008, you know, a 1 month or 2 month reading is not the same as actual prices getting cheaper for anybody in the real world. And the response, the monetary and fiscal response, you know, makes that go away very quickly. So yes, and this is a key part of my outlook going forward. And we need to talk about labor because that seems to be the counter argument. But I'm standing by my call for a recession. I think the economy is much weaker than it seems. And I think it will not be deflationary, contrary to many people's expectations. And this is part of my bull thesis for gold and silver.
Okay, so before we break that down further, I know you have a chart showing unemployment and Fed raising rates. So break that chart down for us.
Okay. Well, this will be included in this weekend's edition of our free newsletter. Quick note, you know, we won't spam you if you sign up, but you have an exclusive first here, Michelle. This is a chart we've just drawn up because it's frustrating to me that you have all these talking heads on TV, and I know I'm a talking head at the moment, but you know, they go on about how the labor market is a lagging indicator. And then they go right on in the next breath to say, but everything's fine. You know, the consumer is strong, everything's fine, after just saying the very thing that makes it not fine. So this chart shows that. It shows that the labor market lags Fed action. It shows that as the Fed tightens, it's when the Fed, you know, reaches that critical point where it knows it's gone too far and it's doing harm, that labor goes into reverse and you get the recession. You can see it. This is like if it's not a 100% indicator, it's pretty darn close. You see those recessions right as the labor market rolls over. And here's the thing about this. If you do the math behind this chart, the average delay between the rate tightening cycle, and this has been a record one on sharpness, is around 14 months. And we happen to be there now. That is, right now, we are at that point, which is the average turning point on these things. That doesn't mean that tomorrow, everything needs to fall apart. But statistically, we're at the point where it makes sense that we're seeing the labor market numbers starting to soften. Jobs report this week notwithstanding. Oh, by the way, about the jobs report, they have a big beat across the board. All the stats you mentioned are correct, but there are also downward revisions for March and February. And the net of the downwards and the beat is actually a loss of 145,000 jobs. So this was not as strong a jobs report as everybody's saying. And I wouldn't be surprised at all to see this one revised down in the future. But even so, the JOLTS report, that has also turned way down again this week. It's still elevated because of all the post-COVID, labor hoarding and all that stuff. But that has rolled over. But before this week's numbers, we saw labor softening. And this is what that chart that we're talking about shows. This is that inflection point. And it's part of why I have confidence. This is an unusual thing for me, Michelle. This isn't an always and everywhere, oh yeah, gold's always going to the moon. This is happening right now that makes me very bullish for monetary metals.
Okay, so let's go back to the idea of a stagflation, which of course means slowing growth but rising inflation. I guess that means that you think that the Fed is going to have to pause or pivot and not continue with its aggressive tightening against as it tries to battle inflation. And we're starting to see signs of this starting to break the banking sector. So safe to say you anticipate a pause and perhaps a pivot? You tell me.
Yes, absolutely. They're saying no, no, no. And I get it. But again, they have to say that. I think they cannot say otherwise. Mm-hmm. And if I'm wrong, if Team Soft Landing turns out to be right, maybe they can put that off for a long time, or maybe it won't even be necessary. Now, they will eventually have to lower rates. I don't think the federal budget is even manageable at these rates. So eventually, and if they're right and the inflation comes down on its own magically, they'll be able to do that without looking like they're panicking. But I don't think that's going to happen at all. As we were just saying, hours after Powell said the banking system is safe and sound, we have another one blow up. And right. This is really important because look at the news. It's not like any of these banks put out press releases. Well, one did, but other ones that are getting whacked, they didn't say, oh, we have a going concern issue or we're worried about outflows. It's just they're all getting whacked in sympathy. What does that mean? That means contagion. That's the very thing that, central bankers, stay up at night worrying about, because in a fractional reserve banking system, there is no bank that has 100% backing for all its deposits. So if you get a real banking panic, a real contagion of sentiment amongst the consumers out there, there's nothing they can do. There's no backstopping the FDIC can possibly do that would actually stop a full-on banking panic. Now, I'm not saying that that's tomorrow we're going to wake up to a banking panic thing. I'm saying this is the systemic risk kind of scenario that we're in, and it's perfectly expectable. That's not a word, I'm making it up. But to be expected in a situation like this, right, where it goes from 0 to 5% in the fastest rate ever. People say, well, Volcker went from 15 to 20. That was 5%. But 15 to 20, that's a 33% increase. 0 to 5 is mathematically an infinite increase in just a year. So this is a big deal. Stuff will continue breaking, Michelle.
Yeah. And of course, it puts the banks in a difficult position because they were holding treasuries that the mark-to-market value changes as they're continuing to raise rates at such a rapid pace. So the question is, Lobo, how bad could this banking crisis get? Because Ray Dalio, in a recent interview focusing on this idea of contagion, he suggested that the U.S. banking crisis could actually turn into a world banking crisis. Let's take a listen to what he had to say, and we'll get your thoughts on the other side.
If you look at the Silicon Valley Bank issue, it's not so much their issue as much as a worldwide issue. And what happened is that, what's a bank? A bank takes in deposits, and then it takes that money and it invests it in things. And so they bought a lot of government bonds that had a higher yield than they were paying out in the deposits. There's a tightness of monetary policy, and those yields went up and the bonds went down in value. And then the amount they have to pay out went up in value. And so they went broke. And that is happening all over. That happens not only through banks. Banks as a whole did a lot of that, but insurance companies and so on, all around the world. Same sort of thing happened in Europe. Same sort of thing happened with Japanese companies, even buying US dollar bonds a lot. And so you have, if you were to mark those to market, you would have a terrible calamity.
So Dalio breaking down how we got to where we are and saying that things could really worsen dramatically. What do you think?
Well, I have to say, I'm not a banking expert, but note that the Fed stepped in here. It wasn't just the FDIC and the unusually large bailouts making everybody whole. The real key point here was that the Fed stepping in and offering to swap out those bonds that were underwater at par. And that was across the board. I mean, that was basically a massive bailout of the entire banking sector. That was big. And it's, even though they were trying to say no crisis, that was a crisis type response. And for a while, it seemed like they were successful, right? The end of First Republic, that was supposed to be the last domino. That was supposed to, the other banks are fine. This was the last one that had too many unsecured deposits or whatever, seeing outflows, and everything was gonna be fine. And Monday, that seemed to be true. And then Tuesday, it wasn't true. And suddenly the panic is back. So if the Fed pulled out that big a bazooka to fix the banking system and panic is still with us, or, I don't know, Michelle. I don't want to be the one to say the sky is falling. I know you'd love to have me be the Lobo Tiggre predicts disaster. That card is in the deck in front of us. I don't know if it's the next one that turns up or if it's later, but there's clearly instability. Let me throw something else out there, though. I think it'd be a mistake to just say, oh, it's just about the banks. With that record pace of tightening, there can be other systemic risks. There's other things that can break. And I think even if the banking thing smooths over, like the Fed really has pulled out the stops to accommodate here. And if they can smooth things over, tweak the FDIC a bit more, whatever, that doesn't mean it's over. I think focusing too much on the banks would be a mistake. The bankruptcies that I think we're going to see going forward into the latter half of this year will be massive. And the very labor hoarding thing that I think masks how weak the US economy is will exacerbate the bankruptcies, because these companies shouldn't be holding on to this much labor they don't need, right? They're going to make it worse because they're afraid to fire people. And then when they've dug themselves into that hole and have no choice, they're going to end up firing more because they'll be bankrupt.
So you're seeing more bankruptcies, credit tightening. As Dalio says, it's not just banks, it's insurance companies, it's other companies, it's lots of companies that are looking at treasuries, as we've been conditioned to do, as safe haven assets. So you surmise then that the Fed will be forced to cut. Doesn't that signal more panic potentially? Yeah, but
the Fed will cut after the panic already hits. They're not going to do it in advance. They may see it coming, but I'd be very surprised that they would get in front of that and say, oh, bad stuff is coming. As Ray Bradbury said, something wicked this way comes, and they warn of it and they're going to take preemptive measures. They never do that. So there will be pain. There will be blood in the streets. And then they'll say, oh, we better do something about this, would be my prediction. You're getting me to make a prediction almost. That would be my projection at some point. That's how I see this turning. And unusually for me, I think this happens like in the relatively near term. I think this happens before the end of this year.
That we have a cut. So let's get back to your department then. What does it mean for gold? Break this down into your thesis for why you're convinced that gold still has some room to go up this year.
Is evolving. I think we're changing from where we've been over the last year with gold mirroring inversely, like a Rorschach ink blot, the DXY, the foreign exchange, because the rates were nailed and it didn't seem to matter, is my theory for why that was happening. But anyway, I see signs now in the data happening now that gold is starting to move sometimes with the dollar instead of inversely to the dollar, and responding more to interest rates. So that's interesting, because if inflation remains as high as I think it will stick, and the Fed is pausing and or pivoting, then you've got real rates remaining high and or becoming even more, real rates remaining negative and becoming even more negative if they pivot. And that historically, I mean, the dollar, the DXY in particular, has been the main variable over the last year. But over the last 50 years, it's been real rates. And since we get, CPI prints monthly, the 10-year benchmark rate functions as a proxy for real rates in between the monthly figures. So this is the forecast here. I think we're going to be seeing a switch from drivers here, from just the dollar to more rates. And in this environment of, recession and worry, I think that more lasting and negative real rate environment is extremely bullish for gold. And one key point real quick is that there's a potential here for this to give us a hiccup in the near term, because the dollar, our friend Brent Johnson, the dollar milkshake guy, will point out that in this recession, you have a credit contraction that actually shrinks the money supply. And we've already seen M2 shrinking. So you could actually see dollars become harder to come by. And people who are used to, as a knee-jerk reaction, trading gold inversely to the dollar recently, they may make the wrong call. If what I'm saying is right, and it changes from tracking the DXY to tracking the 10-year, then betting on the higher DXY being bad for gold will be a mistake. We'll have to see how that plays out.
So there could be a pullback, but you're still very bullish that we're going to see an even higher all-time high for 2023 in gold.
Exceptionally bullish for me. Yes, I think
okay.
Higher all-time high this year.
I love it when I get you to say clear, concise forecasts, because I know how much you don't like doing it, Lobo. But you have told me as well that you think the real opportunity could be with gold stocks, because you've said that the gold stocks have lagged the gold price, and that's where the big investment opportunity could be. So break that down for us.
I'm certainly hearing this from readers. Actually, I should specify, my clients are on board and they get it, but my larger audience in the Twitterverse and LinkedIn, social media and so on, I'm getting a lot of, what's wrong? How can gold be at an all-time high and my junior gold stocks, they're not moving? They're dead in the water. What's wrong? Something's wrong. And I can understand the question. It's certainly, honestly, the reason why we even bother with the stocks is because they give us leverage to the underlying commodity. Typically, if gold goes up 1%, your miners will go up 3, 4, 5%. And if that's not happening, why take that risk? So I get the question. I understand. First and foremost, I do think it's an opportunity. I think it won't last. Why is it happening? I've written an article about this. It's available for free on the website on gold stocks remaining cheap. I think it has a lot to do with expectations. We had this big spike in 2011. And it kind of, petered sideways for a while and then fell off a cliff in 2012 and then had a horrible 5-year slide. And people saw that same pattern with 2020, a big spike, kind of petering sideways for a while. It looked unfortunately like the twin of what happened last time. And what happened last time was a bloodbath afterwards. So I think industry insiders and retail and traders who don't necessarily have a high conviction in the fundamentals, I think they looked at that and they're thinking it's going down. And I think here's an unusual one for you, Michelle. What I have been saying in recent months has been it would take a new all-time high to start shaking that fear. The stocks have been underperforming because many of the people in the space were fearing another 2012 to 2015 slide, right? And a new all-time high after the previous all-time high would be completely different. So this has just happened. We should see in the next weeks, month or two, if I'm right about this. If I'm right about this and gold maintains, remember what I said about it being over $2,000 for the entire month of April. If that continues, all these bears, all these people who are being, I think, unreasonably bearish about gold stocks will have to say, well, wait a minute. The miners are printing money at these prices. Gold's not going down. I'm missing the boat here. And that's good news for your audience watching now, because they haven't gotten there yet, I think the gold stocks right now are a terrific buying opportunity. Gold isn't cheap, just hit an all-time high, but the stocks are on sale.
But we have seen decent returns. The GDX VanEck Gold Miners Index, I mean, that's up about 20% year to date. That's pretty good.
Yeah, and I don't know how much of Kitco's audience focuses on the majors versus the juniors. I'm more on the more speculative end, and I focus on the juniors. They have not done as well. But if you think about it, Michelle, that makes sense. I call those big players, I call them the go-to stocks. It's a phrase that my mentor, 𝗍𝗃𝗧, taught me. So what does that mean? It means, well, when gold's making headlines, as it has recently on a mainstream financial media, not as good as Kitco, of course, but those other guys out there, they finally notice gold. And so where do people go? They go to the biggest and most well-known names. Your audience knows who I'm talking about. So, we've seen those stocks responding much more, but there's a much larger mining stock universe out there. And those big stocks, maybe they're less risky in some ways, but they don't offer as much alpha. They don't have the hockey stick potential of the smaller stocks that I specialize in. So hence the question I've been getting. I think a lot of the junior mining stock speculators out there haven't been enjoying quite as much, upside. But we have seen, the day that after the gold hit that 2085 price point, we saw even some of the crappiest, if you'll forgive me saying so, of the juniors that really have no gold other than in the name. We saw everybody responding. So I think it's simply not true that they're not responding. It is true that they've lagged. I think I've given you the best reason available for why. I believe that personally. And I think that makes for an opportunity. And I am personally looking now to revise my shopping list to see what I can add or what new gold and silver stocks I can add to my portfolio.
So I have to ask, then it begs the question, what is on that shopping list? Which juniors are you looking at?
Well, actually, I said I'm revising. That right now, this shopping list is one uranium stock, and there's one gold stock I already own that I'm looking to average down on. I'm not going to give you names because my clients pay for that, and it wouldn't be fair to them to give that away.
Can you give us one name?
Nope. Just don't do that. But let me put it this way, and I think this is fair for
so you're revising downwards, but you're also looking to add some juniors then.
Yes. But if there's a stock that you really have high conviction in, and you've been waiting for it to catch up for gold, you like it a lot, and you've been kicking yourself, or you've been angry, gnashing your teeth because gold's gone up and it hasn't. If you really have conviction in that stock, and I was in that position, I would look to average down or buy more. I really feel that strongly about the opportunity right now.
What about that famous adage, sell in May and go away? Market is up, S&P 500 up about 8% year to date. I take it you do not think this should apply to gold stocks.
I do not.
But do you see a shakeup in the equity markets?
Yes. I think we actually could see that in a vengeance for the broader markets. There's a lot of fear out there. This banking thing, you can say, oh, it's just a banking panic, but banking is central to the economy. It's not optional. It's not like, oh, this is a problem with taco restaurants or something. It's banking. So if you have systemic risk there, that's very bad news for all the markets in general. But at the same time, that's the sort of thing that sends money charging into safe havens like gold. And
gold stocks as well is what you think that'll be.
Sell in May could actually have people saying, well, what still works? Right? When they're selling, they don't want to just sit on cash in a high inflation environment. That's a guaranteed loss.
Yeah. Well, let's talk about another potential earthquake on the horizon, and that is the debt ceiling deadline. Now, we've played this game before, we've been here before, but arguably there are perhaps other parts in the equation that are on shakier ground this time. And U.S. Treasury Secretary Janet Yellen says that the U.S. could default by June 1st if the debt ceiling isn't raised. Now, this is earlier than previous estimates. So far on the political front, we have an impasse, and some analysts, including RBC Wealth Management, say that this year's political and economic backdrop is one of the most challenging. So again, we've missed deadlines before. Certain bills still get paid. This political charade gets played out for a couple of days, maybe a week. But given the scenario that we're in now, if we miss June, what happens to gold?
I agree with your setup. I think they will come to a last-minute compromise. They'll do something. Frankly, I wish they wouldn't. And all these people of, oh, it's unthinkable. We can't have this disaster of not paying our debts. Well, I think to give credit where due, Peter Schiff does an excellent job of explaining this. These debts mean we're not paying the amount of debt we owe means we're not paying our bills. The whole thing is silly. And this is why we have a debt ceiling. It's to force Congress to do the right thing. I think the debt ceiling should never be raised. Or at best indexed to inflation, maybe, but even that's a cop-out. So the whole reason it exists is to force them to do what they're refusing to do now. So I just, come heck or high water, I think they ought to be forced to do the right thing, but they're not going to. They're going to punt, and things will go fine. But to answer your question, if they actually did, if the Republicans pushed it over the edge to try to gain leverage on the election, the unusual thing this time, or I don't want to say it's different this time, but what I could see being different would be if the Republicans want to hurt Joe Biden or the Democrats in the 2024 election, forcing that default and then trying to pin the blame on the Democrats could be a way for them to come ahead in the election. They'd have to convince a lot of people that even though they're the ones who voted against it, right? They'd have to convince everybody that it's the Democrats' fault. But if they could do that, or if they thought they could do that, that would be a reason for them to potentially think the unthinkable, right? And if that happens, to answer your question, that would absolutely be a fear button. Just mash that fear button, and it would be very good for safe haven assets, including gold and silver.
Right. Well, Lobo, the Republicans are pushing back against increases from the Democrats. As you said, nobody's really respecting the ceiling here. But perhaps this time is different because, granted, we're not really paying the debt, but there's this idea of perception. And the way the dollar is being perceived on the world stage is sort of changing with this de-dollarization trend, which is apparently happening at a faster pace than people would expect. As we know, we've got the BRICS nations making their own deals to trade in their own currencies. India and Malaysia have signed a deal to trade in rupees. India is buying oil from Russia using local currencies. China and Brazil agreeing to trade in yuan. China signaling that it intends to increase its use of yuan. Saudi Arabia said it's open to accepting yuan for its oil. And then, of course, we have this idea of, again, the BRICS coming up with a global reserve currency or asset potentially backed by gold. I take it that that's still some time away. I mean, they're meeting in August, but it's going to take a while for them to get their act together there. But that perception that we have now, doesn't it make the idea of the U.S. defaulting on its debt even more heightened, more problematic?
Yes, but I don't think the mainstream thinkers, the amount of dismissal, if anybody on the mainstream financial media, not Kitco, of course, if they even address this issue at all, it's to dismiss it. Oh, the dollar is still the number one reserve currency of the world. This is all nonsense. Don't worry about it. Or, what's the alternative? The euro, Europe's a basket case. Yuan, nobody trusts yuan. There is no alternative. Well, yes, there is an alternative, as we all know here at Kitco. But I don't think that this perception affects the decision makers at all. And the people like you and I and most of our audience, even though you have a very large audience, we're still a tiny, tiny minority from the general public out there. So I think the de-dollarization trend is real, as you say. It's accelerating. That's not my own research. I don't have the staff to go out and calculate that, but I've seen the numbers. They seem credible. And this is ultimately, I think, the point for people. There's 2 points. One is all these deniers saying, "Oh, it never happened. The dollar be king forever." They're ignoring the fact that it is happening. And even though the United States dollar is still the number one reserve currency in the world, it's been losing market share consistently over the years. That is a trend that's happening now. It can't be ignored. Now, the other thing, though, is, okay, it's a trend that's happening now, but that doesn't mean that we'll wake up tomorrow and the dollar will go away. And I think this is actually a very, very important thing to say, because, people will make scary headlines about this. They'll get all excited. They'll try to use it as a sales technique. Frankly, the BRICS gold-backed currency is coming, so you better buy my gold stock today, right? And I just think that's a little not helpful to the investing clients' outcomes in their investments. I think this is happening. As you yourself said, I think it'll take years. It's not something that informs my investment decisions today. The de-dollarization, it doesn't make me want to buy a gold stock right now. What makes me want to buy it right now is I think we're going into recession, and the recession deniers are going to wake up and smell the napalm soon.
Right. Okay, well, just to give some stats there, according to Horizon SLJ Capital, the US dollar's share of international trade has fallen from 73% in 2001 to 58% now. 58% still the majority, but we are seeing a trend. But you're saying we still have some time before we worry about that. We're focusing on the now, and focusing now means you're looking at recession. So, Lobo, what does that mean for silver? Because we know that silver has a dual component of a precious metal, but also as an industrial metal. And if we're having a recession and slowing growth, how do you balance those two factors out with your outlook for silver?
Right. Well, this is where some of my fellow silver bugs get really mad at me, and I've been dubbed Darth Silver because of my case for a changing use for silver and the increasing importance of its industrial side. And my answer to that is, one, I'm not a silver bear. I still see silver as money, as a monetary metal. And you can see, the data shows that on an ongoing basis, silver still tracks gold, sometimes more, sometimes less, but it is not yet divorced from gold. It is still a monetary metal, and it will respond on days where fear is just really strong and gold's moving. You'll see silver move as well. So that has not changed. But this industrial side is more and more important. And in between those moments, we will often now see silver tracking copper more than gold. And don't get mad at me. That's a fact. Go look it up. And if you want to ignore the facts, then you can't get mad if your investment outcome isn't what you hoped for, right? And
So are you bullish on silver?
Yes, I am bullish, but the takeaway is it's going to lag even more than usual. Even the most ardent silver bulls will tell you in a bull cycle, gold leads, silver lags, and then silver more than catches up with gold at the end. It has been this way since 1971. With now the one exception of 2020. Silver never caught up with gold on a percentage gain basis in the big rally in 2020. So we now have a broken record, but still a very strong one, except for that one time. It's been that way. I do expect that to happen this time. But what I'm saying to the average silver bull out there is that expect that underperformance in silver to be more vicious and last longer this time.
Wow, more vicious. But is there a critical silver gold ratio that you see happening?
No, I think that's changed. And that's part of what I'm saying. The use case has changed. Just if it goes to 120 to 1 again or something like that, that alone won't be enough to force it to revert to the mean. It could go to 150 to 1. If the recession is really bad, if China just stops making solar panels and that demand just goes away. People look at how much silver there is in the COMEX vault, but they forget how much more silver is being mined every day than gold, right? So if the consumption goes away, you could see an actual glut. And especially remember that silver is a byproduct from big copper mines and other industrial metals mines. If those continue cranking out silver and the Chinese stop making solar panels or whatever, you could see a huge glut before this plays out. I'm not predicting that, Michelle. I'm just saying these are the kinds of things that you should consider. Just don't be religious about it, right? Look at what's happening now. And yes, even Darth Silver thinks that silver is going to have a meteoric rise with gold before the end of this cycle.
And when is the end of the cycle, Lobo?
You're really trying to get me to whip out that crystal ball, Michelle. I have to say, this isn't just I don't know exactly when. I think there's some huge variables. And not to sound too scarum-harem, but if the house of cards does come down, if the Fed and the ECB and the powers that be out there, if they actually lose control of this situation, and we go into, bona fide hyperinflation type scenario, then who knows where it goes? It doesn't come down until they lop zeros off the dollar and come up with the neo-dollars or something. But it doesn't happen. If we just have a recession and then they paper it over and they print more money and it goes down the road, I think we're probably looking at a couple years. At least through 2024, and I don't know how long into 2025.
Okay. Let's talk about the other yellow metal, because I know you have some strong ideas on uranium. So elaborate on that.
Well, I'm glad you brought that up, because basically from what we've been talking about this whole interview, it's bullish for monetary metals because they're monetary, not because they're commodities. If I'm right about the recession, the stagflation, that's actually very bearish for all your industrial minerals, including the energy sector, including copper, which is one of my favorite industrial metals, but for after the recession. So basically, I've told my readers that I'm not buying anything in the industrial space until the recession does its worst, until the deniers give up the ghost, and that gets priced in. With the one exception that you've brought up, being uranium. And the reason for that is because it's not just the fundamentals that we've had all along. Uranium has been below the average cost of production. The spot price has been below the average cost of production for many years. What's changed is that we now have actually a 5-year sort of stealth bull market. It's been volatile, 2 steps forward, 1 step back. But we've been seeing uranium prices rising for the last 5 years. This is a significant upward trend. The other thing is that the secondary supply, the Japanese reactor shutdowns, that's all gone. Not only have they stopped selling, the Japanese are restarting their reactors. That's a big deal. And then we've got the war, the new Iron Curtain, and the changes coming to that, and all of that there. And you've got Europe doing this pivot towards, except for Germany, everybody else doing this pivot towards nuclear. So the narrative is now backing the fundamentals. The technicals are there. The chart is upwards. You have a very strong upward trend. So you got technicals, and I'm not a TA, but my technical friends say the chart looks great. You've got the fundamentals that have always been there. And now you've got the thorium matching the uranium. Right? Even Greta said that Germany should not shut down those 3 plants back in the day, right? What more bellwether could you ask for than Greta Thunberg, coming out for these 3 poor reactors that got shut down eventually anyway. So I think this is an idea whose time has come. I think it would take another Chernobyl level event to derail this trend. Outside of gold and silver right now, uranium is the only basis of speculation that I'm willing to deploy capital on. And I won't say it's recession proof, Michelle, but this is baseload power. Like, you might decide not to go on a vacation and fly less, or to drive to grandma's less often and use less gasoline, but you want the lights to turn on when you flip the switch. You certainly want your hospitals and airports to have power come heck or high water. And that's what uranium provides for nuclear power. It's steady baseload power that's there, whether the wind or the sun shines, right?
So how are you playing that idea then in terms of actionable investment?
I have allocated more. There's a larger chunk of my portfolio now allocated to uranium than I've ever had in my entire career. And as I mentioned to you before, when you asked me, what am I buying? The single stock at the top of my shopping list right now. In fact, before we were speaking, I was working on the write-up for a uranium stock I'm looking to add to the portfolio.
And you're not going to tell us what that is, Lobo?
I'm not going to tell you what they are. But
this is your tease. This is your tease for people to subscribe to your newsletter.
Well, yeah.
Okay, but you're long on uranium, and particularly some uranium stocks. If you could,
I'm not stuffing uranium under my mattress. I'll save the lumps for gold and silver. No uranium, thank you.
Right, yeah, I don't recommend that either. So as we wrap up here, Lobo, what would you say is your position of highest conviction right now, given all of the uncertainty?
I would actually say uranium. That's not to say the stocks can't get whacked if we get a market, major meltdown in the markets, but uranium is being underpinned by long-term contract prices. I didn't mention this before. I didn't want to get too technical, but one of the problems with uranium for years has been that many of the big producers had these long, like 5-year contracts that kept going even after the uranium price went down. They were able to sell and keep producing at guaranteed high prices. And that's pretty much done. And we're seeing the buyers now this year. This is another one of these things, not inevitable or not even imminent. This is happening now. The buyers are being forced to the table with the miners to write new contracts, and those are coming in at higher prices. And the spot price never ignores that for long. I think the miners will have to have and will get higher prices. So even in the face of recession, we could see uranium be one of these, shining stars in the night, like gold and silver out there. When nothing else is working, you could see people selling all this stuff that's not working and looking for what's working. And that could fall, uranium's even in tinier market than gold. So without getting too hyperbolic, I think the returns could be extraordinary.
So your highest point of conviction is uranium, and you're more bullish on uranium than gold this year.
Well,
I always like to distill it to a yes or no.
More bullish. Actually, I think the gold price on a percentage gain basis could go higher than uranium. More like a steady gain in uranium, but it's more the solidity of the thesis. Again, absent a Chernobyl level event, I just think the uranium story is as close to a sure thing as you get in resource speculation. Whereas gold, I might be wrong. The dollar milkshake might come and eat my lunch or slurp it away from me or something. I think I'm right. I'm betting with my own money that things will unfold roughly as I've thought. And, so far this year they have, as you pointed out. But this uranium thesis, it just seems, the stars seem aligned, Michelle. I'm very confident that it will.
Okay. All right, the stars are aligned for uranium. Lobo Tiggre, thank you so much for breaking down your investment resource speculation theory for us. Really appreciate it as always, as well as your macro outlook. And I look forward to catching up again soon. Lobo Tiggre, thank you so much.
Thank you, Michelle.
And thank you, as always, for watching Kitco News. A special thanks to our sponsor, Prime XBT. I'm Michelle Makori. If you're watching us on YouTube, make sure to subscribe. I'll see you next time.
On the Spot with Michelle Makori is brought to you by Prime XBT, the leading cryptocurrency trading platform.